Hi, I'm John Pasalis, and this is the Move Smartly podcast. Over the past month, a lot has changed in the world. We've seen two big banks fail, Silicon Valley Bank in the US and Credit Suisse in Switzerland. And we've seen the outlook for interest rates do a complete 180. A month ago, the markets were pricing in another 100 basis point, or that's 1 full percentage point increase in rates by the Federal Reserve. And now markets are pricing in as much as a 100 basis point in cuts by the end of the year. We've seen the Canadian government in this week's budget give banks the green light to help existing homeowners with their mortgages by restructuring their payments or extending the amortizations on their mortgages to soften the payment shock due to higher interest rates. Is the worst behind us, or are there red flags for our economy and housing market ahead? To navigate all these complex issues, I've invited Bank of Montreal senior economist and director of economics, Robert Kavcic, to join me. Robert has been at the Bank of Montreal since 2006, and before that worked in the Bank of Canada's research department. One of Robert's key roles at Bank of Montreal is analyzing real estate trends, and he's one economist whose perspective I enjoy reading because I find he has a very good sense of not just the macroeconomic picture impacting housing, but also a good understanding of the on-the-ground trends that are impacting the housing market as well. If you have any questions about this episode, or any questions about the market or feedback in general, please send me an email at askjohn@movesmartly.com. And now on to our episode. All right, Robert, thank you so much for joining us today on our Move Smartly YouTube channel and podcast. Really looking forward to getting some of your thoughts on sort of the latest macro trends in the housing market in Canada. So thanks for taking the time today.
Yeah, sure thing. Thanks for having me on.
For sure. So I thought I'd kick things off just with the recent bank failures we've had. I mean, obviously, this has kind of thrown a bit of a curveball into the economy and the outlook and a lot of things going on. So I guess, the first question for our viewers and our listeners is, what, and more specifically, the two big ones, of course, are Silicon Valley Bank in the US and Credit Suisse in Switzerland. And what generally kind of caused these failures just out of the blue, it seems like, and, were there different factors that caused one versus the other, or are there, similar factors that caused these banks to collapse kind of out of the blue almost?
Well, so there's a lot to unpack there, and I'm not going to get into like the specifics of how one bank managed risk versus another. And like Credit Suisse, for example, had all kinds of problems long before this episode broke out. So that's not really my jurisdiction. But the root, so two things. One of the root causes is just a management issue, right? So if you're a bank and you leave yourself completely exposed to higher interest rates and you don't hedge off any of that higher interest rate exposure, you're probably going to run into some issues when the Federal Reserve raises rates 400 basis points in the space of a year, right? And so that when you look at like Silicon Valley Bank, that effectively is what happened there. So part of it is an issue specific to some of these banks, but part of it too is a symptom of what's happening more broadly in the economy, and that is we've seen a generational tightening of monetary policy in a very short period of time. Mm-hmm. So those are the first shoes to fall, so to speak, because they were arguably not prepared or poorly managed, but they're also symptoms of the tightening cycle. And okay. So that's where we are.
That's interesting. So basically, they weren't prepared for this massive shock in rates. Which makes sense, but it's shocking that a big bank would not be prepared for that. But I guess the next step is, or the next question is do the markets see more risk from banks? Obviously these are two big ones, but do they think that this is generally contained, or is there fear that there might be another collapse or another failure in the future?
Yeah, so there was a lot of initial concern, right? And you saw, say, regional banks sell off very sharply in the equity market. That was the market's way of kind of showing us where the risk was. Smaller banks losing deposits to larger financial institutions because there was a lot of fear out there. And of course, the Fed and Treasury more or less backstop that and stem those flows. And you've seen the market trading a lot more orderly right now. A lot of it too, and again, I'm not a bank analyst here, but a lot of it goes back to the quality of deposits. So if you have deposits that are, tied to the corporate sector or tied to, the tech sector, they're a lot more flighty, so to speak, than large stable deposits that come in at the household level. So again, just to kind of highlight that some of those issues are in fact firm specific and not an economy wide
I
issue.
see.
But for the most part, I think like policymakers have been pretty clear on this, that the one thing they don't want to see is panic and deposit flight from financial institutions, because that just kind of speeds up the whole process and makes things a lot worse. And the Fed and Treasury have stepped in on that pretty quickly.
Yeah, that's great. Now, I mean, speaking of the Fed, interestingly enough, I mean, before this crisis, I mean, there are a lot of expectations that they'd be hiking, maybe even as much as 100 basis points by the end of the year. And I saw in one of your recent notes, you said the market now is pricing or expecting them to possibly even cut by as much as 100 basis points by the end of the year, which I thought was super interesting. I mean, that's a massive, massive shift considering, 2 months ago, we were talking about hikes and no cuts until, 2024. What was the big factor that kind of led to this shift in outlook and monetary policy? Like, is it just the banks, or what else is kind of driving this?
So the market's been fighting this for a while, right? So the market's been kind of going in and out of pricing rate hikes and rate cuts for the back half of 2023 for a while. And it's kind of like weighing two things here. It's weighing the fact that you have very sticky 5% annualized core inflation in the US, whatever measure you want to look at, which is too high for the Fed on the one hand. So that leans to the Fed tightening more and holding rates up at a level that at least gives us, significantly positive real interest rates to slow the economy and slow demand down. On the flip side of that, I think the market knows that by tightening to this extent, it's going to at some point create a recession and then cause the Fed to turn around and start cutting rates. So the market's kind of going back and forth on when this pivot point actually is. And when you start to see bank failures, the market very quickly says, okay, well, that pivot point for the economy is going to be pretty soon, maybe around the middle of this year. And in effect, bringing forward the timing of when that recession starts, and then therefore when inflation cracks and when the Fed can start cutting rates.
So is this okay, then based on that, is this a bearish signal? Like, are the markets expecting like a recession to kind of kick in the second half of this year, basically, it sounds like?
Yeah, I mean, you could have rates back off because inflation is backing off very quickly. That would be a good signal from the bond market. That's not really the case in the US. In Canada, it is more so. We can get back to that, but in the US, core inflation is not breaking at all. The other way is that, the market can price in a recession and the consequences that come with that. And I think that's what they've been doing through this banking crisis, pricing in a recession. So you hear a lot of talk out there, look, 5-year bond yields are down 70 basis points in the last week. This is awesome for mortgage rates. Well, it's not awesome if central banks have to cut rates because we're in a recession induced by a credit crunch in the bank sector, right? So that's not an awesome backdrop to see rates falling in.
Yeah, and that's interesting. And that's kind of where I was going to go with it next. I mean, this idea of how this impacts the market. Again, like you're 100% right. I think most people on the ground see this and think, okay, this is great. Rates are going to be coming down. We're going to have 4-ish% mortgage rates in the second half of this year, which sounds bullish. But I guess what you're saying is it's not necessarily the case in Canada. And you think we kind of could be leading to a recession in the second half of this year in Canada, not just in the US.
I think so. That's been our base case forecast here all along, that sometime around the middle of this year, that tightening is going to work and put us in at least a moderate recession. The timing has kind of been bumping around a little bit. Interestingly enough, before this crisis kind of broke open in the US, the growth forecast in the first quarter was actually looking light in Canada. So we were probably looking at upside risk, and then this came along and we said, okay, our forecast is probably fine. That upside risk is getting scrubbed out by this. And it's a little early. We're going to really need to see like the some of the late Q1, Q2 data to get a read how the economy is holding up into the spring. But through winter and January, February, Canada's held up very well from a macro perspective in the economic data. But yeah, later this year, I think, like we said all along, it's very hard to raise rates 400 basis points within the space of a year and not see some kind of economic consequence. So the base view here is that we get a mild pullback in the economy, and we've already seen it in housing.
So that's interesting. So when we think about, so you're kind of forecasting a mild recession, it sounds like. And what do you think is helping us, or might help us potentially avoid a deep recession? I think when a lot of people think about, housing markets like Canada that were fueled by debt, that were fueled in part by a lot of investors, I think most people would have expected that a massive increase in rates would have led to, just a terrible correction effectively. And yeah, we've seen prices come 20% off the peak, but what do you think is the difference between us kind of potentially getting passes with a mild recession versus something deeper, and why it sounds like you don't think we're going to see like a massive correction kind of in the second half, and why do you think kind of we might get past it without kind of that pain that most people were expecting?
Yeah, so from like a housing perspective, I would say there are a couple stages to this. One is we had to blow off the froth, and I think with 20% off, we've more or less done that. The second leg would be if we have some kind of deep economic contraction, job loss. That takes the cycle from just blowing off speculative froth to actually now filtering deeper through more like fundamental weakness. And we don't quite see that for a couple reasons. One is that just from a macro perspective, I think like there's a case to be made that there's a lot of cushion in the economy because there's so much excess demand out there, right? So look at the labor market as one example. Typically, you'd go into recession, you'd see a lot of job loss, and you'd see forced selling in real estate, for example. Difference this time is we're coming into this downturn with 1 million job vacancies in Canada, the highest we've ever seen. There's a 1 job opening for every unemployed person in this country. We've never seen anything like this.
Okay.
So in theory, I think, central banks can tighten and break down a lot of the excess demand, but not go so far as to actually kick a lot of people out of their jobs and create a lot of unemployment, at least. And I know that's a very tough needle to thread for a central bank because monetary policy lags and all that. But in theory, that's one reason that we should see some cushion. And then the other side is that if you look like specifically in real estate, there's just no forced selling. And in some past cycles, so like post financial crisis in the US or in the 1990s here in Canada, there was forced selling that brought supply on the market and really accelerated the downturn in prices. What's happening this time is households are sitting on a lot of cash. If you're an investor, you have a very strong rental market that you can kind of buy yourself some time with maybe. And most importantly, you took out a 1.5% variable rate mortgage. The bank is letting you amortize that out and buy yourself a lot of time. I think if we were looking at those payments reset in real time, there'd be a lot of houses on the market right now. We're just not seeing that because of the structure of our mortgage market.
Interesting. So, is it the structure of our mortgage market, or is it like Finance Canada working with banks to allow negative amortizations? Do you know what I mean? Because in theory, those payments should be resetting at some point. There's obviously CIBC hit the news with that, 20% of their mortgage book, the payments aren't even covering interest, So, is a lot of the lack of distress that we're seeing just banks, and I guess through policymakers, perhaps through Finance Canada, and also just working with households, it sounds like, to just soften this payment shock. And it sounds like what you're saying is this is one of the big factors.
I think it is. It's softening it for sure. And like to your point, it's not going away, but it's buying us time. So somebody who took out 1.5% variable, say at the height in, let's say like a year ago, they still have another 4 years to go before that mortgage comes to renewal, and they have to face the music. Well, a lot can happen in 4 years. Interest rates can come back down. Incomes have 4 years of growth. Maybe there can be some catch up there. So it's acting as a big buffer for sure. And even in the federal budget, I mean, you had text in the federal budget encouraging the financial sector and the banks to continue doing this, to continue supporting households and acting as a buffer. Right? Well, the banks are already doing it.
Yeah.
But there's like official text in that budget, pushing to allow this buffer to stay in place. So it doesn't make the problem go away. It buys time. So what happens for 5 years down the road when these mortgages come to renewal? Well, if we're coming to renewal in a still 5 or 6% rate world, then yes, those households are going to have some problems. But I kind of suspect, like, if that's still the case down the road, then you probably will see OSFI policymakers make some tweaks to soften the blow there as well, not have to requalify and stuff like that as well, right? So it does seem like a big important mechanism that's working and keeping supply off the market.
Interesting. So, I mean, that's important to think about, I guess, and with people thinking about why we're not repeating the past. I mean, to your point, like the global financial crisis and even the 90s in Canada, policymakers working with households to keep their mortgages and houses is obviously a huge one. So that's super interesting that, and I suspect that that's probably why, I mean, at least, I follow a lot of the work that you do and a lot of economists, like no one's forecasting a massive correction pretty much, like, and I think, a lot of these reasons are probably part of what's driving that. So that's super, super interesting. When we think about, just kind of turning back to inflation and I guess the macro picture, Finance Minister Freeland kind of came out in the budget and said that, inflation's falling and the Bank of Canada is predicting that we'll hit 2.6% by the end of the year. What are your thoughts on that? I mean, that sounds aggressive. I mean, almost as optimistic and confident as their, forecasts or comments 2 years ago when they promised rates would be low for long. Are they repeating the same mistake here, but with their inflation forecast?
So I will say that when they were calling inflation transitory and saying rates were going to stay low for long, we were happy to say that that is completely wrong at the time, right? Okay. And we were one of the first to come out probably very early 2021 and say central banks got to start tightening because inflation is going to take off and the housing market's going to run on you. And of course, we all saw what happened. Yeah. I'll say this time that 2.5% for CPI at the end of the year is probably not that out of whack. Like it is possible.
Interesting.
Because there are some big base effects that are going to start to come out, especially as we go through the summer. I'll also say that
by base effects, can you unpack what you mean just for our listeners and what you mean by that?
Yeah, so a year ago through spring and summer, you had very big month-to-month price increases, right? Food prices, ag prices, oil prices. And as those year over year is obviously comparing prices today versus a year ago. So as we get into this summer, we're going to be comparing to a much softer level. So even if prices don't move month to month, that year over year rate's going to start to come down just because of the arithmetic. So, that said, is that the best measure to look at? Probably not. What we focus more on is what's happening month to month or over the last 3 months on an annualized basis. And you strip out a lot of the volatile stuff like gas prices and food prices and stuff like that. And so you look at core inflation over the last 3 months. And Canada has actually made pretty good progress on that front. I would say we're down around like 3% annualized now. So we seem to be gravitating towards that 3% or so range for overall inflation.
That's interesting. It seems like we're getting there a lot faster than I think some people thought. I don't know, like a lot of the macro reports I read, over the past year were worried that we would be high for long when it comes to inflation, or it would take quite a while to get back to the target. And to get back to the target by end of this year seems really quick. And so I guess, why do you think that's happening? You mentioned the base effect, but that seems like a dramatic turnaround in literally about a year-ish or 2 years that we're going to kind of be back to, the central bank's target range.
Yeah. So, I mean, well, if we're at 3% at the end of this year, we're still a point above that target range, right?
Okay,
And
sure. Yeah.
and it looks like a lot of progress because we're running at 7 or 8%. But
Mhm.
one thing I've said all along is that it's going to be very easy to go from like 8% to 4% on inflation because you see a lot of temporary stuff fall out, like the run in oil prices and ag prices and the Ukraine issues. You see things like spending on goods really slowing down, if not contracting a little bit, because remember, people bought so much stuff during the pandemic, like exercise bikes and backyard renos and all that kind of stuff. They're not really spending in that area anymore. So goods inflation has really cooled down. So it's very easy to go from 7 or 8 back down to like 3 or 4. 3 or 4 back down to the 2% target is going to be a lot tougher.
Yeah.
And that's where you kind of have to crack service sector inflation, which is proving to be stickier because the labor market's still very tight. Wage growth is still pretty strong. And then you have psychology embedded in households and businesses now too that has more of an inflationary tilt to it. So those are the things you got to crack to get that last 1 or 2 percentage points off. And unfortunately, to do that, you probably need to slow the economy down quite a bit. And in the US, it's even more significant. I mean, there are some mechanical differences between the US and Canada with the CPI. I don't have to get into that, but the US job is looking a few notches tougher than the one we're seeing here in Canada with those same factors in mind.
Okay. So if we're doing a lot better than the US in terms of our inflation and kind of getting back on track, how much can the Bank of Canada deviate from the Fed in terms of their interest rate policies? Like, to what extent? Obviously we don't live in a vacuum. I mean, are we going to kind of be stuck with higher rates just because the US is kind of stuck in this higher inflationary environment, you think?
Yeah, to some extent. Like we're obviously economically very tied together, so typically we don't see those rates deviate too much. We're already seeing the market price in a spread through the rest of this year, i.e. the Fed tightens further and probably holds rates higher than the Bank of Canada does. Canada has, I mean, the data are the data, right? Canada has seen inflation break down quicker than the US. And even when you look past some of the mechanical differences, you still see a softer run rate in Canada. Economy is more rate sensitive here as well, right? Housing just ran that much farther, and households are more levered up than the US. So it kind of argues for lower rates in Canada than in the US. But at the end of the day, like if you're the Bank of Canada and you really fall behind the curve relative to the Fed, you're going to see a lot of weakness in the Canadian dollar, and you're going to start to import inflation back into Canada, which is counterproductive. So we can deviate, but we can't get too far away.
That's interesting. So if we kind of turn it back to housing specifically, I mean, we kind of touched on it. What's your outlook for the housing market over the next year? I mean, is this year kind of where we sort of see a bit of a bottom in prices, or what are you expecting this year and kind of leading into the next year?
So a couple of things. I think you'll start to see the market just clear better, if you know what I mean. So like, and this stuff just as well or in more detail than I do, but the last like 12 months or so, and correct me if I'm wrong, we've just seen the market that's been, it just hasn't been functioning well. Like it hasn't been clearing. You had on the supply side, people that don't have to sell and don't want to accept prices that are 20% lower than they saw a year ago. But on the buy side, you have buyers who are out there and they want houses, but you can't qualify or just physically afford prices that existed 12 months ago at today's rates. So you have kind of this standoff where there's a big bid-ask spread, so to speak, right? And the market's just not clearing. So I think what's going to happen now is because rates have backed off a little bit, maybe sellers' expectations have improved a little bit to reflect the reality. You'll see sales volumes start to pick up again in the spring and through the summer at lower prices. And then prices, I think, like in some markets, like the core of the GTA, for example, we're already starting to see a floor kind of get put in.
Mm-hmm.
Some of the farther out markets that were just that much frothier through the pandemic period probably still have some more room to go to the downside. And
Yeah.
then there are markets in Canada like Calgary, which hasn't really budged at all for some specific issues out there. So it's going to be a little bit location dependent. Obviously, it always is if we're talking about real estate. But
Yeah.
short answer, I would say we're probably going to start to see some markets setting a bottom in the spring and more broadly across Canada through the second half of this year.
Yeah. Okay, that's super helpful. Now I want to turn to another kind of a note you published on our population boom and people, and of course trends we're seeing on the ground, people leaving provinces like Ontario for more affordable markets, like Alberta and Eastern Canada. And I think when we think about that, what's your kind of view on the market? I mean, I find that there are people with different views in terms of sort of the causality, what's driving prices. I mean, to what extent is it demand factors versus supply factors? So what's your view on sort of, the key drivers of sort of the booming housing market in Ontario? And to what extent is it like just this strong demand growth from population versus supply constraints?
Yeah, so this could be a really long story. There's a lot to unpack on this, I'm sure, as you know.
Yeah.
I'll try and summarize it quickly off the start. So if you go back like 10 or 12 years now, we've been extremely bullish on housing because we've always thought there has been just significant demographic strength coming down the pipeline, mostly the millennial cohort.
Mm-hmm.
And we've seen that pretty consistently. We're now throwing 500,000 international immigrants per year on top of what is pretty much maximum domestic demographic demand from the millennial
Mm-hmm.
cohort at the same time.
Mm-hmm.
So you're creating a lot of demand side stress. This is demographics. We always knew this was coming.
Mm-hmm.
On the supply side, I know there's a lot of debate out there. Do we have supply shortages or is it something else? And we've been on the opposite side of that debate a little bit, not because we don't think we're supply starved. We know we are. We haven't been building the right mix of housing units for the last decade to accommodate what's happening demographically here. But the question is, when you are in a very acute situation like we saw during the pandemic, where prices are blowing 30 or 40% per year to the upside,
Mm-hmm.
why is that all of a sudden happening? Is it because the supply and demographic situation just changed overnight? No, it didn't. What happened was the bank cut rates to zero and said, we're going to keep them here. And then a lot of people said, well, this is my free pass to go and buy houses and invest in housing. And so we had a lot of froth build up on top of what is, yes, a very strong supply and demand situation in Ontario. So we can have both things at the same time. You can have speculation and froth, and you can have fundamental supply demand imbalances. And I think we had both.
Mm-hmm.
And so from a policy perspective, what do? Do you go out and say, we're going to double the rate of housing construction to address this, which we physically can't possibly do anyway? Or do you need to do something else like raise rates, which is going to work immediately? And the minute the Bank of Canada raised rates 25 basis points, the housing market went dead.
Mm-hmm.
So I know there's a lot in there, but that's kind of how I think about some of these things. And if you want to push on one or two of those things, that's totally fine too.
No, it's interesting because I during the pandemic, I tended to agree with your analysis. I'm not an unbiased interviewer. I'm highly biased. I obviously look at this stuff a lot, for the record. And I thought it was interesting because, again, not everyone kind of follows what a lot of economists are saying, but I feel like you and BMO were kind of in some ways in the minority view. A lot of people were trying to explain that prices were exploding 30% per year because of some supply issue. And I thought it was interesting that, you were coming out with, with your perspective, which was the, obviously policy and interest rates and all of these things. All of these things combined and still having a long-term supply issue. Now, you mentioned, so I thought it was super interesting when you were coming out with that research. Now, you mentioned, yes, the Bank of Canada cut rates that carved off 20%. but this isn't a fix for housing, right? So it seems like we're going to continue to have this mismatch between supply and demand. I mean, it could be wrong. Like, is the outlook that this is going to continue to put pressure on housing, either prices or rents, because, like you said, it's impossible for us to build enough?
I think so. I think, like, if you want an analogy, there's a, there's a bonfire in the backyard and the fire's still burning. It's just a matter of keeping at a manageable size. And when the bank cut rates to zero and promised to keep them there, that fire really spread across the backyard. And
Yeah.
the supply side people were out there saying, let's build a bigger pit. Well, no, you need to just put the fire out first and get it back to a manageable size, right?
Yeah.
But, like, to your question, so I think what's going to happen here is, first of all, like, the government targets and stuff, like, they need to look like they're being proactive in doing something, but there's no way we're going to double the rate of construction in the next 10 years. We know that, right? The industry is already at max capacity. So the industry is already responding to market forces and building pretty much every last unit that it can. So what we're going to end up with is, if we do go into a slowdown here, and in response to higher rates, we're probably going to see construction activity fall this year, not rise. And we're going to come out of this cycle in the same spot that we came into it in, which is, imbalance in the housing market that can't respond quick enough to the demographic forces we have here, which is the millennial cohort, as well as all of that immigration flow. So it's not like it's a hard one. It's not something we can just fix overnight. It's something you have to plan for 10 years in advance. And unfortunately, for the last 10 or 15 years, we've been building small condos, knowing that coming down the road was a big wave of the population that's going to need single family housing. And so we're mismatched, and it's going to last until that wave of demand goes away.
So is there anything, I mean, that policymakers could or should be doing to kind of, help affordability, for this next generation or this next cohort? Or, what do you think is kind of the path forward?
So, I mean, first of all, like, just getting policy set properly and taking a lot of the froth out, that's obviously one. There's been some work done on just speeding up the approval process and things like that, some of the zoning side issues. And I will say that, like, yes, it's going to be extremely difficult to actually hit the supply side targets policymakers are looking for, fine. But if you can set an environment that makes supply more responsive, more elastic, almost, to allow supply to come in quicker when it's needed, that would help alleviate some of the stress going forward over time. And I mean, that's mostly it. The other thing we've seen more is households spreading outside of the core of the big cities. The pandemic kind of sped that up, and post-pandemic kind of work habits have allowed people to kind of remain further outside the core of those cities. That's actually a pretty good affordability valve as well, right? Pre-COVID, you couldn't live in one of the markets 2 hours outside of the GTA if you had to commute in every day. But if you're commuting in every, maybe once or twice a week, maybe it's reasonable. So if you push a lot of population outside the core of the big cities, you kind of alleviate some of the stress that way. Problem is, you need a lot of infrastructure outside in rural areas and smaller towns, like bandwidth and internet infrastructure and stuff like that. So none of these things are going to just make housing affordable tomorrow, unfortunately. It's just the nature of where we are demographically.
Yeah. And I mean, speaking of that, the demographics, I mean, one thing you mentioned I thought was interesting in your note was, one of the key drivers of, this population or immigration boom and all of this is really just kind of filling the gap that's kind of we're creating every year with boomers retiring. I think your note said something like 300,000 are getting out of the workforce every year or something like that. So I guess the thinking then is this boom that we have in the population is necessary to kind of fill those gaps. I mean, the negative side effect of that is just housing affordability, or it's going to get worse in the short term, is kind of what I'm getting from that. Does that sound about right?
Yeah. So from a long-term perspective, I think it's pretty clear the benefits of immigration are pretty clear, right? You're replacing labor force that you're going to lose at the back end from retirement. So if you think of it from a long-term growth potential perspective, you need labor force to keep the economy growing longer term. That's fine. The problem is when you suddenly increase those targets to what are historically very, very high levels, you don't get 500,000 people per year drop on an economy and then immediately absorbed into the labor force, right? You have mismatches in skills training and credentials and language barriers and all this kind of stuff where somebody comes in today, it may take them some time to actually filter in and create new labor supply. But what they do right away, the minute they come into Canada, is they need a place to live. And they have demand for infrastructure and physical goods, right? So you're creating a lot of inflation right away the moment that person comes in through housing and physical demand. But the benefit takes time to actually show up because that person has to get assimilated into labor force and things like that. So long term, yes, it's obviously healthy, but short term, you're exaggerating an already pretty acute problem, which is demographic stress on the housing market. And you see it reflected in prices.
Yeah. That's super interesting, super helpful. I don't want to take up too much of your time. Just want to thank you then for I don't know if there's anything else you wanted to add, but I wanted to thank you for taking the time today to chat with us. It was super helpful, kind of get your views on sort of the macro environment and kind of some of the things that you're seeing in terms of the outlook for the housing market.
Yeah, no, happy to do it, and happy to follow your work too. I read your stuff and watch you guys pretty closely. You seem to be one analyst or one team that knows what's going on out there.
I appreciate that. Thanks so much, Robert. Awesome. Well, thanks again for taking the time, and hopefully we'll have you on again sometime in the future to regroup on some of the latest trends.
Okay, sure thing.
Thank you.